In this video, we're going to talk about how a company conveys information about its business through basic accounting principles used to prepare financial statements. But before we get to those, we need to cover some fundamental terms found within these statements. A company's financial position is made up of three components: assets, liabilities, and equity. Assets are what we typically think of when we imagine a company such as cash, building, and inventory. What all assets have in common is that they are resources the company controls which will yield them some benefit now or in the future. For example, cash can be used to purchase materials, and factories can use these materials to make inventory, which can be sold. The time it takes a company to complete this process from start to finish is known as the business cycle. When a company sells a product or service but doesn't require immediate payment, the payment due to the company is considered an asset and is called an account receivable. For example, say Company A agrees to buy some manufacturing material from Company B, and the contract says that Company A will pay in 1 year. Between A's purchase and their payment, Company B reports a receivable, which is a specific amount they are fairly certain they will receive in the future from Company A. Because of this near certainty, the company can report the asset right away, even if they don't get the cash until later. This is known as the accrual method of accounting, which focuses on when revenue is earned, not when cash is received. Liabilities and equity represent claims on the company's assets. What do we mean by claims? Say your friend lends you $20 and they expect you to pay them back. Their expectation could be called a claim on that money. So a company's liabilities and equity represent claims on the firm's assets from groups such as the company's owners or lenders, also called creditors. This is why liabilities and equity are thought of as obligations the firm has, which will result in some kind of sacrifice in the future. For example, to get cash, the company would take out a loan from a bank. The loan eventually needs to be paid back, creating a future sacrifice. For now, the company benefits by having more cash or other assets on hand, and the bank has a claim on the company's assets. Another example of a liability is an account payable, which could exist when a company makes a purchase on account, essentially promising to pay cash later to suppliers or other parties, as Company A did in our previous example. Companies may also sell shares of stock to generate cash. Stocks are essentially ownership rights to the company, and their owners, called shareholders, are given a small say in company decisions for each share they own. The more stock a person owns in the company, the greater say they have. Shareholders elect knowledgeable members from amongst themselves to form a group called the Board of Directors, which appoints management personnel within the company to oversee daily operations while keeping the stockholders' best interests in mind. The money collected through the sale of stock is called contributed capital. When buyers acquire shares, they own a portion of the company, which is now expected to return that capital back to its shareholders at some point. This expectation is quantified in what is called stockholders' equity, which represents the fact that stockholders eventually want their contributed capital back, together with a share of the company's profits over time. They weren't just handing the company their money to be nice. To recap, assets are current or future benefits controlled by the company, and liabilities and equity are the claims on those assets, representing future obligations. Liabilities are called priority claims since they are paid back first, and equity is referred to as the residual claim on the firm's assets. Because nothing comes for free, the amount of assets a company has is equal to the claims on those assets. In other words, total assets equal the sum of liabilities and stockholders' equity. This equation will always be true. A report that breaks a company down into its assets, liabilities, and stockholders' equity is called the balance sheet. It shows the value of all assets the company has control over and the claims on those assets. Amounts related to a particular kind of asset, liability, or equity interest are grouped together in what are called the accounts of the balance sheet. For example, instead of listing every machine a manufacturing company owns, they will probably report the total value of all machinery together under an asset account called equipment. Accounts receivable and accounts payable, mentioned earlier in the video, are also examples of balance sheet accounts which consolidate total amounts expected to be received or paid, without listing individual customers or suppliers. The balance sheet shows these consolidated totals at a specific point in time, often the last day of the year. If you look at any example, you'll notice that the total assets, called the left-hand side, will be equal to the sum of liabilities and equity, called the right-hand side, making it a balance sheet. Get it? Once again, this will always be true. Now, not all transactions affect both sides of the equation. Say, for example, a company purchases a machine for $500 in cash. It may look like nothing has changed, but that's because one asset, cash, has decreased, while another asset account, equipment, has increased. Our formula still holds, as the total amount of assets has not changed, and the rest of the equation isn't affected. If the total amount of assets were to change, there must be a corresponding change on the other side of the equation to the company's liabilities, equity, or both. Let's do one more example. This is where the company stands as of the last day of their first year of operations. They continue business throughout the following year, until December 31st, when it's time to prepare another balance sheet. Balance sheets don't necessarily have to be prepared on December 31st, as long as they are prepared periodically. Again, the balance sheet lets the investing public know what the year-end balances are in all asset, liability, and equity accounts. So, what happened during the year? Both the yellow and light blue square grew. What could this mean? Some transactions must have increased the company's assets while increasing its liabilities. Maybe they purchased materials on account and need to pay the vendor, or maybe they took out a loan. When a company earns money during its business activities, it's called revenue. When you buy a $20 shirt, the store will report $20 of revenue. Profit, however, is the sale price minus the cost of producing that shirt. Materials, labor, and other factors all contribute to the cost of selling an item, and these amounts, called expenses, are usually grouped together under accounts such as salaries and cost of goods sold. These expenses are recorded when the corresponding good is sold and revenue is earned. Other expenses may not relate to specific products, like paying interest on a loan or electricity bills for the company's offices. After deducting all of the company's expenses for that specific period, the amount left is called the net income. Now, what does a company do with these profits? It has two options. It can distribute the profits to its shareholders, called a dividend, or keep them within the company for future growth. Any net income that isn't distributed to the shareholders by the end of the year is listed under an account called retained earnings, which can be found in the equity section of the balance sheet. When the company decides to keep the profits, say from a cash sale, assets increase and so does equity in the form of retained earnings, keeping our equation balanced. The payments of dividends decreases the balance of retained earnings and, if paid in cash, decrease the cash balance. Because the retained earnings account represents all of the profits a firm has made but has kept within the company, it's a number a lot of people pay close attention to. In fact, there is a second statement called the income statement, which shows all of the profit-related transactions during the year. Keep in mind that, in accounting, the terms profit and income are used interchangeably. The income statement explains the profit-related operations during the period. Our loan example from earlier wouldn't appear on the income statement, because borrowing someone's money with the promise to pay them back doesn't inherently create any profit or loss. If the firm had to pay some kind of interest on the loan, which would reduce the company's profits that year, an interest expense would be reported on the income statement. The income statement and other additional statements, such as the statement of cash flows, help investors understand how a company got from one balance sheet to the next by providing details relating to specific accounts. The balance sheets in the earlier example are essentially before and after pictures, while other statements explain what happened in between. This is why balance sheets are described as snapshots, taken at a specific moment, whereas the other statements summarize events that happened during the time period in between. Now you've reviewed some of the fundamental concepts of the financial statements, which work together to help the investing public understand a company's financial performance. Before you go, here are some quick study tips to summarize what we've talked about. Assets are benefits, and liabilities are claims on the assets representing sacrifices. Assets will always equal the sum of liabilities and stockholders' equity. Balance sheets show totals at a specific point in time, whereas income and cash flow statements show changes over a period of time. Accrual accounting means recording revenues and expenses as they occur, not when cash is received or paid. Hopefully, you're now ready to tackle some of the basics of accounting. Good luck!